Welcome to That Annuity Show, the podcast that will make you an expert in explaining annuities to your clients. Give us 30 minutes each week and we'll shave hours from your client presentations. Now, here's your host, Paul Tyler.
Hi, this is Paul Tyler, and welcome to another episode of That Annuity Show. And with me are all our hosts and co-hosts. Mark Fitzgerald, welcome.
Thanks, Paul. Good morning.
Will Moorcroft, good to see you.
Great to be here.
And Ramsey, welcome. And you brought a very interesting guest today. Do you want to do the honors of the intros?
Absolutely. So we're very lucky to have Jamie Hopkins from Carson Wealth join us today. Jamie is somebody who is a thought leader in the retirement space, and he's written books. He's very prolific on social media, and a very important resource in the space very, very broadly. And we're lucky to have him. So, Jamie, why don't you tell us a little bit about what you do, and tell us about your role at Carson Wealth.
Yeah, well, first, just thank you for having me on the show. I know a lot of, my friends and colleagues have been on before, and so we'll probably hit a little bit of that. Dr. Wade Fowle and Cheryl O'Connor, I know, was just on recently too. So I really appreciate joining that group. Yeah, I can tell you a little bit about myself, the personal and professional side. I do like to weave in the personal so I don't sound like a robot at some point, right? But, I'm a father of three. I've got a dog here, too, who's usually in my office now that we work from home. And so any one of those four could make a guest appearance on anything. And then my wife's an attorney. We live outside of Philadelphia. And I have been, kind of in the retirement space, I guess now probably nearing about 13 years of kind of being focused on retirement income planning. And that's what I love. It's, I tell people it's what I go to bed thinking about, wake up in the middle of the night, write something down in my notebook, and then get back up in the morning and get back at it. At Carson, I do a couple different things. I head up our retirement division. We have about 123 offices. We're about a $13.5 billion firm, about 250 advisors, and that's our core group. And then I head up our coaching company, which is a secondary company, and head that up. And I've been only in that role for about 10 months now, but we coach about 1,400 advisory firms in the coaching division. Prior to joining Carson, I spent about 7 years at American College, helped co-create with Professor David Littell, one of my mentors, the RICP program, which is all retirement income. And a lot of people know that, Dr. Wade Fowle joined us as part of that program and team. And then Wade has since stepped into my role since I left the college about 2 years ago, who's a fantastic researcher, if not the best, one of the best in the retirement space.
Sorry, I just had to unmute there. So yeah, we were lucky to have Wade on maybe a month and a half or so ago. So look, Jamie, we're in trying times, and we focus a lot on this podcast around annuities, which is really a story of guaranteed income, and wanted to find out, like, what are you seeing among your colleagues in the advisor space around the role of guaranteed income today, specifically coming from the life insurance industry, versus 4 or 5 years ago? How do you think things are shifting? How has the need shifted, and how has the attitude towards annuity shifted in recent years?
Yeah, I guess there are kind of multiple stories we could go through there. I think maybe I'll start with the first one, which we've talked briefly offline about this on the show, so we'll recap, which is, there's still a large contingent of what we would say are AUM fiduciary style advisors that don't use annuities, right? And part of that's, not having easy access to it. Some of it's misconceptions. There's a bunch of reasons why, but, I'm of the opinion that group has become, kind of more open to annuities as a fixed income solution over the last 5 to 10 years. So going back to when I first was building RICP, there was a really big pushback against annuities from the non-life world, right? So if you weren't at a multi-line company or life insurance or broker dealer that really pushed it, that fee-based advisor was not a big fan. And you would get the, never use them, the steak dinner sales stuff is all bad. And that started to shift. And it's taken a while, but you do see some of that momentum occurring. You've seen the development of new products, right? Which you've talked about before, right? The asset-based ones to try to get more to that market. But I think that part of what's occurring there is also, 10 years ago, nobody was getting education on retirement income planning. It was still accumulation planning, right? And so the programs out there focused on that, whether it was a traditional life insurance, CLU program, CFP, they didn't have income planning in there. And really where annuities fit well is on the income planning side. I mean, yes, some annuities are used for accumulation purposes, but their strength is, right, income. I mean, that's what they're designed for at their core, just like life insurance at its core is designed for death benefits, right? And when we use them for those purposes, they shine. And now we've seen more and more research supporting that. So as you said, Dr. Wade Pfau, Moshe Molesky, Michael Finka, Michael Kitces, Roger Ibbotson, just throwing out a bunch of names out there in the space. But they've all started to say, how do we look at income as part of a holistic plan? And how can it help actually achieve better client outcomes? And I mean, that's really the answer, right? If we can use a product, it doesn't matter what the name is, it doesn't matter what the cost is, it doesn't matter, where we get it. But if it helps achieve better client outcomes, we should consider it, right? I mean, that's really what it comes down to. So as we've gotten better research, I think it's helped make the case to those CFP and fiduciary advisors that we do need to consider lifetime income as annuities and planning. So there's definitely a very positive swing towards that. I do think there's still a huge hurdle of access for that group. The more time I've spent with advisors, the more I've learned is they generally use what's right in front of them. So if it's not easily available, if it's not integrated into their systems, they don't use it, right? I mean, that's just reality. It shouldn't shock us either. That's probably every professional out there in any case, right? If you don't have the tools right in front of you, you often don't go find them. And so that's a big hurdle moving forward.
Jamie, you've authored a number of books, and about 5 or 6 years ago, you wrote a book about the risks that retirees face. I guess, given what's going on today, anything that you would see changing in terms of what your suggestions would be, and you see annuities fitting into play in a greater role today?
Yeah, so I'll answer the one first, then we'll hop back. I do think annuities, they fill a nice need. And when we think about fixed income, when we think about lifetime income, there's a very big need for that. As we, over the next 10 years, as we see fewer and fewer retirees, enter retirement without pensions, there is a need to offset some of that lifetime income with their own pension, right? Which would be an annuity. So I definitely see that. And I hope to see the numbers start to change, right? I mean, we can talk about all this that we want, but, total annuity sales haven't really taken off over the last decade, right? Some have done better and, variable has come down a bit. So there's kind of a give and take going on there in the actual numbers. But stepping back is, you asked a good question. When I wrote the book for Forbes on retirement risks, and it was about 5 or 6 years ago now, which is amazing that's been that long since I wrote that, because I still have like painful memories of trying to write that on nights and weekends. Because they were very strict with deadlines. Sometimes you write stuff and it drags on forever because you're in charge of writing. There, I was not in charge of when things were due. And I think I ended up with 22 or 24 like specific retirement risks in that book. And, we built a lot of that into RICP, and, that was we did white papers on that too after. But there's a lot of stuff that we still didn't think about. And what I describe those are the known unknowns. And some people like to say the unknown unknowns, but I actually say they're the known ones. Why? Well, we don't know what it's going to be, but we know that there are going to be risks that we've never thought about before. The two of them that I think are pertinent today is obviously global pandemic. Global pandemics have occurred before, so I guess you could have made an argument, but we really hadn't experienced it in a recent time period. Nothing like this, right? Like COVID-19 changed the way that we kind of feel about disease, pandemics, right? Possible disruptions to retirement and work and economies. and it's a big change. Now, I'm not sure we get a whole lot of really specific, like what's the best thing to do out of a COVID-19, because I don't think any of us have figured that out yet. But it's a risk, right? And then the other one is negative interest rates. And negative interest rates, and so I remember the conversations probably starting to occur back then. And if you go back then, what you got was the Fed. Maybe I could find something from 08, 09, 2010 time frame where the Fed might have commented on negative rates and said, we'll never see them. A decade ago, there were still a lot of economists that believed, right, you would never see real negative rates, right? Now, inflation-adjusted rates, of course, we've seen those negative before, but real negative rates, there was a lot of economists that believe you'll never see those because you'd be better off, right, just taking your money and shoving it in the mattress, or, right, I heard somebody recently say buying 2 mattresses and shoving it in 2 mattresses, right? Like, there was this notion that, like, why would anyone take less money, over time? And I think that there was a lot of theory behind that that's kind of proved to not be true. And then you go back like 4 years ago, and we probably heard some other countries start to consider it. And the Fed here was saying, oh, we'd never use that here, right? Like it wouldn't happen in developed countries. And then you fast forward 2 more years, and all of a sudden, developed countries are now using negative rates, right? And you've got the Bank of England, 3 weeks ago, saying, you know what, we're looking at how to use negative rates. And okay, so now, really one of the countries that we look at, especially from bonds and advanced markets, is, close to the US, not neck and neck, but at least we view that as an advanced financial market, is saying, hey, we're about ready to use this. And we know now that the Fed here has discussed negative rates, right? Now, negative rates, we thought would just collapse certain economies too. And maybe they haven't had the positive benefits that some people have argued, but it hasn't collapsed things, right? Like negative rates have now existed. Well, that's a really big challenge. And here, at least, we're just at the point where, short-term rates are essentially zero, right? Like that's where we are. The Fed came out and said, hey, expect another couple years of that. That puts pressure on a lot of fixed income solutions. And that's the conversation that now brings up, is when you used to expect, and clients would come in and say, hey, I'd be really happy with 4, 5, 6% in my bonds, right? Just get me 4, 5, 6%. Well, now, right now in 2020, you're like, I can't get you 5, 6% in safe bonds, right? I can't get that with, tips and, government backed, securities or anything like that. So, are we going to see people starting to reach for income, chase that yield, off of the efficient frontier and really move to take on more risk? Or are we going to see a more holistic approach, which is looking at insurance products, looking at, possibly life insurance, but possibly fixed index annuities as a bond replacement, which is, what Roger Ibbetson's research shows, what Wade has demonstrated as part of withdrawal strategy, from an income standpoint, can improve your plan. And I also think we're going to see more international. I've kind of been touching on that, but China, I think, is at 3-4% yield. They're about a third of the U.S. bond market size, if you look at that. And so, if you're starting to think about risk, is that more efficient than zero here? If you take in the default risk of China, probably, there's at least an argument for that, because I think if China defaulted on all its bonds, we'd have a huge problem here too, because they're holding so much of ours, right? Like it's kind of hard to imagine, a huge risk with them that wouldn't also impact our markets at this point. So I think we're going to start seeing some more holistic views of, how do we find fixed income solutions in this prolonged low interest rate environment, which might just be the norm now, right? Okay. We might never go back. Yeah. And I know I've been talking for a while. So
wow. You're hitting on 2 like big topics here in the business. And I'm waking up at night. It's different reasons, but it still ends up being related. So if we kind of double click into first one, pandemic, and let's talk, then we got to hit the negative interest rates. I mean, this is one where I don't think we can probably think enough about it. But like on the pandemic, I could argue that the pandemic has fundamentally changed the life insurance space, right? It's changed how companies are underwriting, how they're issuing the policies. If you were a company that had to send medical examiners into somebody's house, forget about it. The ones who are clean, and I've talked to these companies, directly. I just had a conversation with a president of one of these companies a couple of days ago. They're doing exceptionally well if they could do this, sell insurance on the phone, and they could do it. By the way, we're beneficiaries of this. People aren't lapsing their policies. So, finally, Mark, they're recognizing and the value of what we sold them, right? Annuities, I don't know. Jamie, okay, the market, we had that big crash, okay, but then went right back up. Okay, do you think consumers have really changed their mind about guaranteed income? Has the pandemic by itself shifted their attitude?
No, I don't think on the consumer side yet. So what I see a lot more on the consumer side is, when they look at, when they're doing their quick, in their head analysis of, kind of yield versus, this yield versus risk type of analysis. And I'm not saying like when I use those terms, it sounds like it's a much more complex thing, but they're just saying like, what can I get as a return? And am I willing to take that volatility risk? I think we're seeing more people overweighted in the market today than also holding cash. The fixed income, the annuity, the bond world doesn't look attractive to a lot of people who set expectations at 5-6%, or right, like you still get the stories. Well, back in 1983, I was getting 16%, and there's this notion that like, yeah, that was high, but like, why would I ever take 1%, 2%, 3% when there used to be these higher things? So aren't I better off just riding the market? Or just sitting in cash, right? Like I think a lot of people like that opportunity value of cash over where the bond market is today. And so we see that. I mean, I've seen people that pulled out of market or backed off some, and they're still just sitting in cash. The cash for a lot of people is probably higher than it should be, but they don't know where else to go with it. So they're hesitant to put all of that in the market or, buy fixed income, which just doesn't look real appealing to them today.
Well, the other thing that sometimes we see people do when they do implement in fixed income or in dividend paying stocks, they end up taking an enormous amount of additional risk, more than I think they realize, to get those incremental basis points. Every time I hear somebody say dividend paying stocks are the new fixed income, I cringe. And what's interesting is that will come home to roost, even though the stock market has done well. Dividend payouts are reasonably under threat everywhere because companies are going to be suffering in terms of earnings. That's how they have to pay the dividends. So I think it may take time for that to actually sort of play itself out, but I think it has to eventually. But what I think is potentially interesting though in our space is, well, what does this say about the potential value of mortality credits? So in a world where you have to take a lot more risk on one instance, or you have to presumably settle for low rates, mortality credits are still there and they're uncorrelated to everything else. So how should we think about the role of mortality credits? Do people understand them well enough? I think the answer is no, but I'm curious.
Yeah. No, people don't really understand the value of mortality credits. And to some degree, mortality credits get to the kind of true notion of like why certain types of insurance is valuable and why other types of insurance is not so valuable, right? But yeah, people don't understand mortality credits so well. There are some people that do a good job of explaining it. I've always thought Moshe Milewski's, explanation and use of mortality credits is probably one of the best out there. He does a really good job of articulating that. And I've shown it to people, and you try to visualize this, and part of it's if you have that 10% risk and there's 10 people, they'd all need to fund for it, right? Because it's a high enough risk. But if only one of them actually, is going to suffer from it, wouldn't it make sense to all pool the assets together and everyone just pays 10% instead of everyone paying 100%? Well, that's a good, version of it too, right? To really simplify, this is pool funding for a pooled risk. And we don't know who's going to live to 105 and who's going to pass away at 72, right? And so we're pulling together to some degree that risk, and that's where some of the mortality credits are essentially coming from. One of the challenges with mortality credits, which is similar to the deferral of Social Security, though, and I wrote an article on this, and I actually still don't think this has gotten enough like attention yet, and it will. Somebody else like smarter and more articulate will write this again, and it will get some traction. So anyone who's listening that wants to write this again, go ahead. But I kept thinking, like, why do we have such a hurdle to get people to defer Social Security? Or same thing would be to, essentially defer your income out by buying an annuity, right? So it's a similar type of notion that the problem is that we're actually telling people to take risks to get a lower return is essentially what we're telling them. So, take a step back. You're like, okay, mortality credits are great, but to win here, you essentially have to take on the risk that you could die earlier than projected. So we are telling people to take on a risk to get this benefit. And so when we frame things up like that, right, generally speaking, people are a little bit risk averse, right? On average, right, we dislike risk. We would rather lock in certainty and, not chase risk for a return. That's generally how people work. So I think that some of it is reframing those conversations. At least with Social Security, I thought about it's probably better to explain what you lose in benefits if you claim early, right? Like, what's your potential loss by claiming early? And to some degree, that's probably where income annuities fit in well with mortality credits, is showing how much faster a portfolio would deplete without this income, right? So like showing that, hey, without this, you fail at 90, you fail at 92. That you're actually showing them by making this decision, you are taking on a different risk that you don't like. And so I do think we're going to get better and better at like how we frame up conversations, because we're still learning in the behavioral finance world, right? Like we're at the very early stages of that. But my assumption is that we're still presenting a lot of those things in the wrong way, and that we're actually unknowingly kind of demonstrating a risk to get that return of mortality credits, right?
Yeah, when in fact it's a risk you're short and you're actually covering it.
Yeah.
That is the inherent irony.
So,
yep.
So just sort of transitioning over to this second risk, negative interest rates. Fascinating topic. We did a survey with some consumers and said, what are these topics that you'd be most interested in listening to or learning about? Negative interest rates.
Yeah.
This was in February. Yeah, Jamie, nobody wanted to hear that. I'm like, well, I don't know. It's just maybe they just may not understand this yet. If we're in the annuity business, though, where's the silver lining here? Because Mark and I had a conversation yesterday. How do you get people excited about a 5-year MIGA rate at 2.75? I'm telling you, negative interest rates, Mark, it's 0 points at 2.75. Jamie, if I'm in the business of creating income for people, how do I get excited about going into this period of time?
Well, it doesn't surprise me. People don't want to talk about it because I don't think you get people excited about that. Like I hate to say it, like that's not in the world that we've been framed up around interest rates. That's not a positive, right? Like nobody looks at that and says, you know what? I can't wait till there are negative interest rates, right? And it's kind of true regardless of where you are. Like insurance companies aren't psyched about negative interest rates. Mortgage companies aren't psyched about negative interest rates, and consumers aren't, right? So there's not really this like clear group that like is like, hey, I really want to see that, right? Even though low interest rates for borrowers is nice, but I think, a lot of people still flip around and they worry about that, right? For as great as the mortgage world is now, right? To get a mortgage at 30 years under 3, the same as, on the other side, like I can't invest in anything safe and get a good return. So I don't think you're going to get people excited about it. I think there's still a lot of people that just don't believe the U.S. will ever see negative rates. And, I probably put it closer to, I'm more in like the 50-50. I don't really know. But even 5 years ago, I probably would have agreed with people and said, we probably won't see negative rates here. But now, I don't know. Basically, the Fed's saying we're not going to raise rates for 2 years and basically zero, and real rates are in the negative. So, I mean, we're not that far from it at this point. And, if we had another pandemic, right, in the next year that was equally as bad as this year, could you say any type of action is off the table? I don't think so, right? So if you got some crazy mutation of COVID and it was twice as bad as this is, Could you see them reach for anything? Yeah. I mean, I think that's possible. Then that puts a lot of strain on, as you said, pension funds, insurance companies, investors, lending. It really challenges the system that we built, which was built on this notion of inflation and positive returns for safe money.
Hey, Jamie, on that line of discussion, so your folks, your advisors, how are they broaching this topic with their clients when you've got clients that are looking, or those that are looking for a portion of their assets to be in some type of fixed income investment? How are those conversations looking?
Yeah, so I would say for a lot of your more like mass affluent, 500,000 to $1 million of investable, it's still diversification, right? And the reality is bonds haven't lost their diversification value, right? Like that part is still true, even though that like some of the bond funds, got dangerously close to some liquidity issues, right? This year, if it kind of had to bail some of those out, but they worked, right? Like they did provide that, alternative correlation to some degree, not totally unrelated, but that's really what the value is for that group. So having them understand that we're still taking risk off the table, even though we might not be getting a great return. So I do think there's more people that are just willing to sit in the bond funds and ETFs, probably less individual bond holdings than prior, but that's an interesting conversation too. I kind of got sucked into this conversation earlier this summer, which was, for income purposes, should you talk to your clients about holding individual bonds? Because, at least right in their mind, if they hold that to maturity, they're made whole, right? Whereas bond funds, even though the valuation technically would be equivalent, but bond funds, we saw some of them get hammered back in, March and April, losing like 20% in a week. And if you were having to liquidate that, you were taking a real loss then. So there is some conversation about that occurring again. But, bond markets tend to recover fast. And that was true again now, right? Like they did bounce back pretty quickly. I think like the longest down period, Morningstar published something. It was only like a year or 16 months, right? That the bond funds and bonds actually remain down. So that's a really short period of time, right? So if you still think about the value as a diversifier, there's a lot of value there. Now, if you're chasing yield, that's a different conversation. What we see there is people starting to look at some different alternatives, whether they're looking at REITs. You heard before, I mean, there's a lot of this notion that I should go buy dividend stocks, but that's not really doing the same thing, right? That's an equity, and it's part of your equity position. It's not doing anything else, right? Like that's a huge misconception. And I think a lot of advisors just leave that be when clients talk about it too, because I feel like it's just like this tough conversation. They don't convince anyone of anything, right? Like it's kind of like going online and trying to tell somebody that like their political belief is wrong. But like when people see like income coming out of it, they're like, oh, this is paying me, it's a huge mental hurdle to overcome. But we see things like bridge loans too, people looking at some of those funds. But I mean, again, those are higher net worth, right? So what stuff can you go kind of chase out there that isn't, structured notes, right? Products obviously getting some attention too, but that's our more, higher net worth clients chasing yield.
One other, just to follow up on something you said earlier, which, I agree with 100%. You said that there's an education gap, or, for advisors they don't have education or access or at their fingertips. And I agree with you, whatever industry you're in, people use what they're familiar with and what's in front of them. How do we, as an insurance industry, change that dynamic?
Yeah, I mean, it's moving. I think some of the things are, getting the tools into these platforms. So, when I go around to the RIA world, right, a lot of them kind of have investment and annuity platforms that they use, right? And if they don't have products on there, they're not going to use them. So it's continuing to get stuff out there so it's easy to use, that compliance is signed off on it, and they know how to position it. So, I mean, I think the insurance world's done a better job at that over the last couple of years, is how does this stuff fit into planning? Again, if you go back like 15 years ago, when I was kind of first into this industry and looking at the life insurance stuff, it was very much still geared towards like product sales, right? Not really incorporated into plans. it wasn't like, how does this improve your overall retirement picture? It was like more of a single shot solution. And I think that's gotten better. That'll help the advisory world adopt more. But it's slow. I mean, some things are changing, but none of that has like the, change tomorrow. Literacy improvements and training improvements are always a piece of things, but when it's never been shown, right? Like education alone is never the only solution to something, right? Like ever. There's no research. You teach people about employee benefits, but if you don't put the right systems in place, they still don't use them, right? Like we can teach people stuff, but you have to create systems that encourage positive behavior. And that's, basically the whole idea of nudge, right? And, that basically, has been part of the whole automatic enrollment system and auto escalation system, because we can still teach people, but if we don't create a positive framework for action, we don't get good action. So that's the next part, is how do we frame these into the decision making that's occurring? How do we educate them? CFP's gotten better. They do have like income, retirement income as part of the coursework now, but that's like 3 years old. It wasn't part of it when I got my CFP, right? Which is amazing, right? We didn't teach income. We really don't teach products as part of that. So they don't get a great understanding of the different annuities and riders and solutions, how they can be paid for out there, right? So that's out of the core education program for advisors, really still isn't a part of it. So there's a lot of work to be done there. I mean, I think some of the things like RICP has been beneficial. RMA, which is another retirement designation out there, has been beneficial to that. But, that's not going to be enough alone. So I think that's part of it.
Yeah, and then just to sort of continuing your discussion, as you mentioned, we had Cheryl Connor on. She's done some great work with her platform. Where do you see us, Jamie, in terms of maturity of platforms? If I'm an advisor, I really want to create, pivot my practice to focus on income distribution. If I kind of, walk through and look, at the tools around me, that, is there a lot of opportunity still for these for the software industry to mature to support this?
Oh yeah. So our CEO Ron Carson said this before too. He's kind of said, we're basically a technology company that happens to be in financial services, and a big value that we've created for our advisors is essentially building a ecosystem where technology integrates. So all the technology out there today we kind of joke about this, is integratable, but nothing's integrated. And It is a mess. And if you look at what we have today, I mean, we're probably, I don't know if it's the right number. I've heard this from some other people in Silicon Valley. We're probably in that like 7 to 8 years behind where the rest of the tech world is, right? So like in 2020, we're playing around with like 2012 technology, right? That's how far we are behind. And like when you look at stuff like app stores and the ability to download, and these apps talk to each other and they sign in, like literally, right? My Facebook app, right, could sign into 20,000 other apps. My financial planning app might be able to sign into like 2, right? Like it is, really, really far behind. That lack of integration has actually slowed down, I would say, just technology developments in the space. There's some people working on it. Oleg Tischevitz has got a company in Invent.us, and that's they're trying to build something that's going to integrate all this stuff. If that happens, we'll actually see more technology develop in this space. I don't think we have enough, and I've changed my position on that. If you look, Michael Kitces has that map of all the tech, and you look at that and you're like, oh my gosh, there's so much. There's only so much because we can't integrate any of it. Like if that was an app store, you'd be like, why do I only have 120 apps on the whole financial service side? It's actually not enough technology, but it's miserable trying to integrate stuff today with APIs, and companies aren't willing to work with each other. They don't have the support. They don't have the financing. That's going to get better. And as that gets better, we're going to get more interesting solutions, because advisors don't have to put the person's name and their address in 3 different places. That's slowing down adoption of a lot of these platforms. And when we'll make that leap, and it's going to occur, like whenever it occurs, it's going to occur fast, which is it's like an exciting thing. Like it hasn't happened yet, But when we see that, it's going to go from, 0 to 200 in a year and a half. Because if you could imagine today, right, like take that step back and think if we had a single hub you could go to and everyone who wanted software, products, financial solutions could tie in there. And as an advisor, you could just log in and say, you know what, I really do need fixed income annuities in my platform. I'm going to connect here to you guys. And all of a sudden, all of that's available to all my clients. And I just compare and I go and drop them in. Well, that's essentially what my, the app store is today, right? That will occur. And when it occurs, it's going to be really interesting because the people who can get there fast are going to get crazy adoption. And, it'll really fundamentally change the way we see financial services when that technology integration starts to occur.
Jamie, how about on the coaching front of your business? Have you seen a big shift in terms of, I guess, either the dynamic or topics that people are seeking out coaching?
Yeah. So most people, so our coaching company is a little bit interesting. So I mean, I'm obviously biased. I head it up. I think we're the best coaching company out there. But we have 11 executive business coaches. So to some degree, we have scaled the non-scalable portion, which is, a bunch of one-on-one coaching. And we do have a practice management system that we relaunched this summer and looks great and is really helpful. But most people come to us because they want to grow their business. We had a lot of people coming in the doors April, May time period, right? Because market's going down. They really weren't sure what to do. And we had really good growth and just pick up right then. And then I'd say probably the last 2 months has been a little bit more like people are trying to get back to normal. So one of the questions we get asked a lot is just like, what should I be focusing on? We're getting a lot of people that are looking at, digital ads, digital events. That was really good going back like April, May. We're definitely seeing some, screen time burnout for events. I think, the people you get there, engagement is good, but the numbers across the board we've seen for live events have dropped down. But most people, it's, how do I position myself? How do I develop my value prop? And then how do I grow? And it's a lot of accountability. It's a lot of focus. Getting back to the other point, right? It's really easy to get distracted. It's probably easier to get distracted today than it's ever been in the history of the world. So having accountability is really important. So that seems to me to be the single best reason to have a coach right now is to have that person that holds you accountable, because you could do a whole week and just be back-to-back Zoom calls and not move forward whatever business thing you needed to move forward. It's really easy to fall into that today. So having somebody to hold you accountable, I think, is really important. Sometimes when you had to go into your office, you're around your whole team, that there's actually a social part of that holds people accountable from getting work done. Because if I have to go sit in a room and I'm like, hey, I didn't get that done, right? There's peer pressure, social peer pressure that creates accountability. Distance, I think that falls off a little bit, right? You hop on a Zoom call and it's like, oh, this week's crazy. It's unprecedented. I didn't get anything done. Everyone's like, oh yeah, like it's 2020. Welcome, right? So I do think, however you want to build that accountability for yourself right now is going to be big. I think we'll get a lot of people in November and December trying to figure out what in the world they're going to do next year, right? I think people are thinking in their mind, like, it's going to hit midnight, the end of 2020, and next year is a new year. Reality, though, is like, it's not a hard change, right? Like, what's a problem in December is still going to be a problem January 1, right? And the nice thing is, though, behaviorally, people do use those dates as big, right, decision points to make change. So I do think we'll see that as an impetus for change. And I think we're going to see a lot of people probably doing more annual planning this year than we've seen previously. Like last year, everything was so good. I feel like a lot of people were just like rolled into 2020, just like cruising. And it's going to cause a little bit more soul searching here, especially if you said, I think maybe Paul said it earlier, right? If you were really like driven by in-person stuff, those advisors are struggling, right? Like if your whole business was, I go and I sit down and my value is to sit across the market at a table and sell the life insurance, and that's how I get all my clients, and I didn't change, they're struggling, right? You've got to find other ways to deliver value today.
Great, thank you.
This was great, Ramsey. What we're almost at top end of the time. What are the thoughts? This is we had Jamie. We could go for an hour here.
Yeah. Unfortunately, we don't have more time. So, Jamie, we'd love to have you back sometime soon. Look, a bunch of interesting things came up in this conversation. I think, the one that's always struck me that you brought up was this idea of ease of use for advisors. And so it's not just about education. It's not even about sort of availability. It's like it has to be sort of right there on the screen. And that's because I think, and to be perfectly fair, being an advisor is you've got a lot of different roles you have to fill. And one of them is just going out and meeting clients and talking to them. So it's time you spend on frictional things it creates inefficiency. So that leads into this this one, pardon me, key issue you highlighted, which was integration, and how important integration is going to be on a going forward basis. What does integration do? It will bring that access to advisors' screens. So integration is key. And the other reason I think it's interesting, and you brought this up, is that historically insurance sales didn't incorporate a planning element to it the way it needs to today. I would argue that's also true in some ways of the financial advice business. It was a little bit more about wealth management. So that's going towards financial planning. And so integration will be a very important element of actually making sure that everything fits together, and financial planning is a part of this process. So those are my key takeaways from the discussion. So thank you very much for that.
Yeah, thanks. And I know we didn't get to the topic you wanted me to discuss about the fiduciary conflicts with AUM, but you kind of hit it there at the end, right? Which is, there is a move there, and we have to identify that, right? Almost all compensation models have conflicts, and can we get to focusing on planning first? All of the integration, all this movement is going to help with that.
Yeah. I don't know, Mark, Will, any final thoughts, questions?
No, this was Jamie, really appreciate it. This was chock full of, great perspectives. I think valuable perspectives for the folks that typically listen to this program. And they're grappling with, the two things that you highlighted as challenges. We've written books on it and whatnot. I mean, it's unprecedented. And I think these conversations help because we're all trying to ultimately help clients or, help individuals with their retirement situations and income needs. And it's compounded by the circumstances that we're confronted with right now. So having these types of conversations and kind of putting our, brain power together to try to come up with ways to confront them is really, really helpful. So appreciate your thoughts.
Yep. Thank you.
Yeah, I thought this was great. We obviously covered a lot of different topics. It was very informative, and we'd love to have you back on at some point going forward.
Yeah. Hey, Jamie, this is great. Where, actually, I think the question may be, where can't we find you? Let's see. I see you on Investment News. I've seen you, let's see, where else? Insurance News. You've been quite quoted all over the place. How should we follow you if we want to, get insight into what's happening in your head at 2 a.m. when you jot these things down?
Yeah, I mean, the best two ways to follow me are definitely just social media now. I mean, on Twitter, it's @retirement risks. And then on LinkedIn, I mean, it's my name. You can find me there. Yeah, I mean, I write for Investment News, Forbes, Kiplinger, and wealthmanagement.com. And then I do a video series, as you said, for Insurance Newsnet on Rewirement, which was my third book, I guess.
Okay.
But yeah, I do a lot of a lot of media stuff. So it's, almost something out there every day. And I have so that's probably the best way. I'd say follow me on Twitter @retirement risks. My website's jamiehopkins.com, but it's a really beautiful website, but I always tell people I'm not really sure what the purpose of it is. I guess it's a business card online, right? It's like content too, but best to follow me on social.
Excellent. All right. Well, listen, hey, thanks for joining us. We definitely will get you back here if you'll show up. We guarantee good questions. And again, thanks for listening to our show. Listen, if you like the show, subscribe to us, tell your friends. I don't know if you don't, that's okay. We'll leave it there. But join us again next week for another really good episode of That Annuity Show. Thanks.
Thanks for listening. If you've enjoyed the show, please rate and recommend us on iTunes, Stitcher, Overcast, or wherever you get your podcasts. You can also get more information at thatannuityshow.com.